The U.S. Federal Reserve recently kept the interest rates unchanged at 5.50%. Despite fears that these high rates might push the economy into a recession, this hasn't happened. The strong job market and positive economic indicators show the economy's strength. However, these higher rates pose a risk to the returns from stocks that pay dividends. Due to the Fed rates hike, when companies borrow money or get funding through bonds, loans, and convertible debt, they face higher interest costs. This increase in interest expense cuts into the profits that could be used to pay dividends. When profits drop because of these higher costs, two things could occur. First, the stock price might decrease to reflect the lower profits. Second, the valuation multiples might increase because investors are paying more for reduced future earnings. Although this might temporarily support the stock price, it can lead to greater price swings. In times of high interest rates, savvy investors often choose stable dividend-paying stocks that can withstand economic pressures. Warren Buffett, known as the Oracle of Omaha, consistently picks companies with strong fundamentals and competitive edges. These are the companies that can maintain or even grow their dividends despite economic challenges. While many investors chase stocks with high dividend yields, Buffett prefers those with moderate yields from companies that are strong and successful. By the end of the second quarter, the majority of the stocks in Buffett's portfolio were from companies with a reliable history of growing and paying dividends. Buffett believes that the true value of a dividend stock lies in the company's current and future earnings potential. To find such companies, investors should examine their dividend histories, looking for those that have consistently increased their earnings and paid dividends for at least 5 years. This approach is evident in Buffett's long-term investments through Berkshire Hathaway. For instance, the company's dividends from the Coca-Cola Company grew from $75 million in 1994 to $750 million in 2022. Similarly, dividends from American Express rose from $41 million in 1995 to over $300 million in recent years. Buffett also stresses the importance of monitoring a company's revenue and cash flow growth rates, as these metrics are crucial for assessing a company's operational efficiency and its ability to maintain its dividend payouts. In some situations, a company may show higher earnings used for dividends due to cost reductions rather than actual growth in revenue. However, if a company's revenues are on the rise, it indicates that the core business is expanding and generating the necessary profits to support dividend payments. Cash flow is another essential indicator that Buffett monitors closely. It represents the money available to fund various operations. A company with negative cash flow is unlikely to sustain operations in the long term or continue paying dividends. The most reliable dividend stocks have consistently demonstrated their value regardless of market conditions. These stocks have significantly contributed to the S&P 500's performance over the years. For instance, between 1993 and the end of 2022, the S&P 500 rose approximately 777%. When dividends are included, the increase was about 1,400%, with dividends making up roughly 20% of the market's total return. Buffett advises investors to focus on companies with robust dividend histories rather than investing broadly in the stock market. He also champions value stocks which are priced below their intrinsic value. Historically, while growth stocks have yielded a return of 626,000% since 1926, value stocks have outperformed them with a total return of 1,344,600%. During the high inflation period of 2022, value stocks proved resilient, decreasing only by 7%, whereas growth stocks, often chose for their high dividends, dropped about 28%. In 2023, value stocks have lagged behind growth stocks, with the Russell 3000 Growth Index outperforming its counterpart by 22%. However, value stocks are expected to recover as they typically perform better over the long term. Value stocks, often trading at discounted prices, have also demonstrated their reliability in paying dividends. Companies that grow steadily and withstand economic challenges tend to increase their dividends gradually. For example, Chevron, a company of Buffett's portfolio, has consistently raised its dividends for 36 years. Buffett's expertise in selecting stocks for passive income shines through as Berkshire Hathaway is expecting to collect over $6 billion in divided income in 2024. The analysis of Buffett's Berkshire Hathaway's 13F filings revealed top-performing stocks known for consistent dividend payments. These stocks are from Berkshire Hathaway's portfolio for the third quarter of 2023, and we particularly focused on companies that consistently distribute dividends to shareholders. Let's start with Citigroup Inc. Citigroup Inc. ranks as the 12th largest holding in Berkshire Hathaway's portfolio and is highlighted by Warren Buffett as one of the top dividend stocks to consider. The company, a major provider of financial products and services to consumers, corporations, and government institutions, has been a reliable dividend payer since 1990. Currently, Citigroup offers a quarterly dividend of $0.53 per share, resulting in a yield of 4.25%, one of the highest in Buffett's portfolio. In the third quarter alone, Citigroup returned $15 billion to shareholders through dividends and share purchases. At the end of the third quarter of 2023, Citigroup was held by 79 hedge funds. This marked an increase from 75 hedge funds in the previous quarter, with the total value of these holdings nearing $7 billion. Next, we have Bank of America Corporation. Bank of America Corporation stands as Berkshire Hathaway's second-largest investment and is recommended by Buffett as one of the prime dividend stocks to consider. Buffett has been a shareholder in this leading financial services entity since 2017, drawn by its appealing dividend yield, which is currently 2.86%. Bank of America pays a quarterly dividend of $0.24 per share and boasts a 24-year history of consistent dividend payments to its shareholders. Berkshire Hathaway's holdings in Bank of America are valued at approximately $28 billion, which generate around $999 million in annual dividends. At the end of the third quarter of 2023, Bank of America was supported by 88 hedge funds, holding stakes worth $31.3 billion. This represents a slight decrease from the previous quarter when 90 hedge funds held shares in the company. Number 3. Apple. Buffett first invested in Apple in 2016, and it has since become the largest equity holding in Berkshire Hathaway's portfolio. Apple's appeal for Buffett is clear, given its robust dividend and revenue streams. The iPhone remains a powerhouse in generating cash, maintaining its stronghold in the premium smartphone market. Also, Apple's expanding services segment continues to boost its revenue growth per user. Apple's approach to returning capital to shareholders is notably generous. The company resumed its dividend payments in 2012 after a hiatus since the mid-1990s and has increased the dividend annually since then. Even more significant is Apple's share repurchase initiative, where it has bought back over $600 billion of its own shares in the past decade. This has bolstered earnings per growth and reinforced investor confidence in the stock. The company aims to achieve a net cash neutral position where its cash reserves match its debt level. Currently, Apple holds net cash of approximately $45 billion and generates about $100 billion in free cash flow per year. This strong financial position suggests continued dividend growth as Apple plans to return most of its cash to shareholders. Despite trading at a premium, about 32 times forward earnings, the company's substantial repurchase program and strong cash position justify this higher valuation. For dividend growth investors, Apple remains an attractive option to consider for their portfolios. Number 4. Visa. Buffett has been a shareholder of Visa for over a decade, during which time the stock has not only outperformed the market, but has also seen its dividend increase annually. Visa's enduring competitive advantage, a critical factor in Buffett's investor strategy, lies in its status as the world's largest payment network. This makes Visa the preferred choice for banks issuing new credit cards, especially for international use. Visa's main competitor is MasterCard, another significant investment in Berkshire's portfolio. Building a payment network to rival Visa or MasterCard would require many years, if not decades, of development. Visa is particularly well-positioned to benefit from the global shift from cash to digital payments, with its extensive payment network already established. the incremental revenue from additional transactions directly enhances its profit margins. Management is committed to returning most of its growing free cash flow to shareholders, primarily through dividends and share repurchases. Recently, Visa's board approved a substantial $25 billion multi-year share repurchase plan, underscoring this commitment. In contrast, it paid out $3.75 billion in dividends in 2022. Given its nearly $20 billion in annual free cash flow, Visa has ample capacity to continue increasing its dividend, maintaining a pattern established since its public debut in 2008. Currently, the stock trades at a forward P/E of just 26, which represents a discount both to its historical valuation and to MasterCard, which trades at about 30 times forward earnings. Number 5. T-Mobile US. T-Mobile US is a recent addition to Berkshire Hathaway's portfolio, with Buffett acquiring shares in 2020 following the merger with Sprint. This merger significantly enhances T-Mobile's spectrum asset, accelerating its 5G network development and establishing it as a frontrunner among wireless network operators. The result has been consistent market share growth, increased average revenue per account, and a rapidly expanding home internet business. However, the standout feature of T-Mobile is its robust growth in free cash flow, FCF. Last quarter alone, it generated over $4 billion in adjusted FCF and forecasts an FCF of between $13.4 billion and $13.6 billion for a full year. In 2024, the company aims to achieve $18 billion in FCF, matching the performance of its more established competitors as they strive to upgrade their networks and reduce debt. T-Mobile's strong FCF has facilitated aggressive share buybacks. The company initiated a $14 billion share repurchase program in late 2022 and announced an additional $19 billion in total shareholder returns in September 2023, including a new dividend policy. Management plans to increase this dividend by 10% annually for the foreseeable future, a commitment supported by T-Mobile's solid FCF outlook and ongoing paybacks. With the stock trading at less than 16 times projected 2024 earnings and a promising earnings growth trajectory, T-Mobile shares represent a compelling investment opportunity. Finally, we have American Express. American Express Company is a prominent player in the U.S. credit card market, offering a range of credit payment card products and related services. Its offerings include payment and financing solutions, network services, accounts payable, and expense management products and services. American Express has a notable 34-year history of paying dividends, a key factor in Buffett's decision to invest. Annually, Buffett's Berkshire Hathaway collects approximately $360 million in dividends from American Express, yielding 1.21%. The company focuses on high-net-worth individuals and other credit card companies, which significantly contribute to its earnings. As of the end of the third quarter of 2023, American Express was held by 74 hedge funds, with the total investment valued at over $25.6 billion. This marked an increase from the previous quarter, which saw 73 hedge funds invested in the company. Berkshire Hathaway remains the largest shareholder among these funds as of Q3 2023. That's all we have for Warren Buffett's style of dividend investing. So are you ready to pick some strong dividend stocks like Buffett? Start by checking our companies with a solid track record of paying dividends. Don't forget to hit subscribe for more insightful investment tips. What investment topic should we tackle next? Drop a comment below with your ideas.